Today, let's start with a national thing. Everybody, yesterday, the Feds hiked up the rates 25 bips, but it was already really intact. But the big thing was that they were talking about doing it another 6 times coming into 2023. So let's see how the Fed funds actually, the rate affects you. The federal fund rate, which is set by the central bank, is the interest rate at which banks borrow and lend to one another overnight. Although that's not the rate that consumers pay, the Fed's moves still affect the borrowing and saving rates they see every day. One single quarter point rate hike from near zero levels will have a minimum impact on household finances, McBride noted. However, this is just the beginning, he added. Effect of the rate hikes is what is really going to have an impact on the economy and household budgets. Borrowing gets more expensive. Long-term fixed mortgage rates are already edging higher. Since they are influenced by the economy and inflation, the average 30-year fixed rate home mortgage is now above 4% and is likely to keep climbing, according to Jacob Channel, senior economic analyst at LendingTree. A $300,000 30-year fixed rate mortgage would cost you about $1,400 a month at a 4% rate. If you paid 4.5 instead, then the same loan would cost $131 a month more, or another $1,572 each year, and $47,000 over the life of the loan. Many homeowners with adjustable rate mortgages or home equity lines of credit, which are pegged to the prime rate, will be more directly affected. Most ARMs adjusted once a year, while a home equity line of credit or a HELOC adjusts immediately. Anyone with a variable rate loan may want to refinance now into a fixed rate, said Mark Schneiber, managing director of Oxygen Financial in Boston. There may not be another opportunity. Shorter-term borrowing rates, particularly on credit cards, will also quickly head higher. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark, so expect your APR to rise within a billing cycle or two. If you owe $5,000 on a credit card with an APR of 19% and put $250 a month towards the balance, it will take 25 months to pay it down and cost you $1,000 in interest charges. If an APR edges up 20%, you'll pay an extra $73 in interest. A single quarter point rate increase isn't likely to flip cardholders' financial world upside down. However, all rate hikes, even small ones, are unwelcome news for folks with credit card debt, said Mark Schultz, chief credit analyst for LendingTree. Borrowers could call their card issuer and ask for a lower rate, switch to a zero interest balance, transfer credit card, or consolidate and pay off high interest credit cards with a low interest personal loan, Schultz advised. Even though auto loans are fixed, payments are getting bigger because the price for all cars is rising. So if you're planning to finance a new car, you'll shell out more in a year ahead. Car buyers taking out loans for a new vehicle borrowed an average of $39,000 in 2021, an increase over $4,000 from a year earlier, according to Experian. As a result, monthly loan payments hit a record high of $644. A quarter percentage point difference on $40,000 loan is about $5 a month, or another $300 over the life of the 5-year loan. Still, the Fed's rate increase likely will not have any material effect on what rate you get, said Bankrate's McBride. Nobody is going to have a downsize from the SUV to the compact because of the interest rates. Federal student loan rates are also fixed, so most borrowers won't be impacted immediately by a rate hike. However, if you have a private loan, those loans may be fixed or have a variable rate tied to the LIBOR, prime, or T-bill rates, which means that as the Fed raises rates, borrowers will likely pay more in interest, although how much more may vary by the benchmark. That makes this a particular good time. Identify the loans you have outstanding and see if refinancing here makes sense as well. Savers get a better return. While the Feds have no direct influence on deposit rates, they tend to be correlated to change in the target federal fund rate. As a result, the savings account rate at some of the largest retail banks have been hovering near rock bottom, currently a mere 0.06% on average. Even as the Fed starts to raise its benchmark rate, deposit rates will be much slower to respond. Many banks are not going to be passing along higher rates to savers, so where you have your money parked is going to be really important, McBride said. more from personal finance, thanks in part to lower overhead expenses. The average online savings account rate is at least 3 times higher than the average rate from a traditional brick and mortar bank. If you have a $10,000 in regular savings account earning 0.06, you'll make just $6 in interest in a year. In an average online savings account paying 0.46, you could earn $46, while a 5-year certificate of deposit could pay nearly twice as much, according to depositaccounts.com. However, because the inflation rate is now higher than all of those rates, any money in savings loses purchasing power over time. Let me repeat that. Any money in savings loses purchasing power over time. Look for other options with better rates, advised Yaming Ma, an assistant finance professor at Columbia University Business School, such as money market funds, bond mutual funds, or bond exchange traded funds. There are alternatives out there that will require taking on more risk, but with increasing returns, she said, as long as you're somewhat shielded from the recent market volatility. Set aside enough cash to cover everyday expenses so you are protected against the big ups and downs, Mess said. The rest can be invested in something that can get a good long-term return.